It's Zach Hartsock, ACI Wealth Advisors, process portfolios with a new feature called Markets in Minutes, where we quickly survey the major markets that U.S. investors typically participate in. For those of you that don't know me, I'm Dak Hartsock. You can learn more about me at dakhartsock.com/about. And let's jump right into it. What we're seeing here is a chart of the S&P 500, and I'm using it because I want to highlight a couple of quick things. If you look down to the lower left, you may see kind of a crosshairs or whatever. So if we bring it down here and look at the lower left, you'll see a gray line coming up above a yellow bar and turning red. What that indicates is when the market is potentially overbought. And what that means is just that too many investors have chased the market higher too quickly. And it creates a condition that sometimes results in the market pulling back, sometimes results in an extended period of consolidation. Sorry about that. And if we look at each time it happens, you can see that really that's kind of what happens is you can see a pullback occur anywhere from within a few days to a few weeks. And why that's relevant today is if we look over here, down here at the bottom right, we can see that the S&P is showing that it's potentially more overbought than it's been at any time in the last 3 years. So something to be aware of when you're an investor is understanding what's happening in the broad markets. I want to take a quick look at this sector. This is financials, and they've been in the media an awful lot recently. And here's why. They've had a remarkable run, particularly since about the 6th, 7th of November, and then when Trump got elected, they just shot straight up. So we saw about 11% rise, 10% rise in about 4 or 5 days. That's pretty sharp, and then it just kept on going. And what we're seeing here is kind of the same thing that we saw in the S&P, except even more pronounced. This sector is extremely overbought. That doesn't necessarily mean anything other than there's good odds that there will be a pullback, or perhaps it won't go very far for a while. One of those two things is very, very likely to happen. There's no guarantees. But again, something as an investor that you should be aware of when you're looking at buying the market or specific sectors within the market. You can do this if it fits within your plan, but you just need to be thinking about what's happening and how it might play a role in your investment plan. Now I'm going to have a look at the 10-year Treasury, that is the U.S. Treasury bond. And I kind of want to talk about this in particular because I think it's going to impact a lot of investors over the next couple of years. What we see here is what's known as a dot plot of the yield on the 10-year. That's what you get paid when you buy the bond, right? Kind of your dividend. Over the summer, it was about 1.4. Last week, it closed at 2.6. That's over an 80% rise in about 5 months. I think, like the markets, the stock markets, the bond markets have gotten a little bit ahead of themselves. I think probably we'll see pullbacks in both areas. But when that pullback comes, particularly in the bond market, it's a good time to do some serious thinking about what you're hoping to achieve in your bond investments and what time frame, because bonds and bond yields have an inverse relationship. And what that means is, for example, if you had bought the 10-year Treasury over the summer and thought, I'm just going to hold it for a few months because I'm a little worried about what's happening, and then you didn't sell it, your principal on the bond, meaning what you paid for it, has fallen considerably as yield has risen. So I think we're going to be in a rising interest rate environment for the next couple of years, and I think it's important to make sure that's part of your thinking when you invest in bonds, because there are some risks present in bonds that we really haven't seen in this generation, in my mind. So again, something to be aware of. I want to talk about gold briefly because this is something everybody, for whatever reason, gets fascinated with. It's not something that I, as an investor, am particularly excited about, but I know a lot of people out there are. So let's talk about what's happened with gold this year. In the summer, it was up fairly high, had a pretty good run. There's a lot of billionaires that came out earlier in the year saying, you have to be in gold, and it's where we're putting our money, and this and that and the other. And they've done that before. And historically, what's happened is gold gets bid up, has a pretty good run like we saw this year, and the billionaires sell. And then the individual retail investors just kind of keep holding on to it for whatever reason, and gold falls. And what we've seen is gold has fallen about 18% since the high this summer. My opinion is I think there's more pain coming. No guarantees, but that's my perspective. We've seen this pattern repeated over the last several years where gold has a heck of a run, and then 3 years later it's 40% lower than it was. So again, if you've got a little bit of the gold bug that bit you, do some thinking about what's happened in the past with gold and why you're buying it. What we see right now is a chart of world markets outside of the United States. This is primarily Europe and Japan. Um, and this is developed world stuff. It's got some exposure to China and so on, but mostly developed world. So if we look at the crosshairs here on the left, this is where the year began basically, and if we look over on the right, this is kind of where we are right now. So it hasn't really changed very much. I kind of am breaking step with a lot of other managers in that I don't think Europe's a good place to put money, and I haven't thought that for a while. I don't think Japan is a good place to put money, and I haven't thought that for a while. And the reasons for that are Japan is simpler. They're stuck in deflation. They're doing everything they can do to get out of it, but they've had modest results at best. So I'm reluctant to put dollars into Japan. Um, Europe has got another batch of problems. They have imported, a large number of refugees that I think are going to create some very serious cultural problems for them, which will therefore impact their ability to produce goods and services and grow their economies. And I think that this is something that hasn't adequately been thought about in terms of its economic impact on Europe. And you'll see a lot of managers that talk about how you've got to put money into Europe right now and it's going to be the big surprise and this and that and the other. And maybe they're right. I don't believe that any upside in Europe over and above the United States is sustainable for more than maybe 6 months here or a year there. I don't think it's something that we can see over a 3-year period, 2-year period, 4-year period, because of these problems. I'm not part of the school that thinks just because something's cheap you should buy it. You can go out and buy a 1970 Volkswagen Bug for probably $500. Doesn't mean you should. And that's kind of the way I think about Europe right now with the problems they've got and the issues that are coming with the refugees. I think we're just seeing the beginning of that. Let's have a quick look at the dollar, and then this will wrap up. What we've seen is the dollar has strengthened considerably over the last couple of years. Here we are in mid 2014 and had a pretty strong run up, and now we see that it's broken out again and moved up even higher than that, than the highs of 2014, 2015. This is a little problematic because as we see a stock market rising and earnings beginning to also grow in the U.S. markets, to have the dollar continue to show strength can be problematic over the longer term and intermediate term, because when the dollar gets too strong, it begins to have a negative influence on earnings. So I'm hoping that, or thinking rather, like the markets, be it the stock markets or the bond markets, whatever, that the dollar's gotten a little ahead of itself, and then we're going to see a pullback and maybe an extended period of consolidation, quite a bit lower than maybe we are now. I'd like to see the dollar somewhere between maybe 96 and 97, 98. If we stay much above this for too long, it's going to hurt earnings. And that, of course, hurts prices in the stock market. So that wraps up our survey. I just wanted to take a quick look at the major areas where U.S. investors participate. If you do have questions or you'd like some additional perspective on this, feel free to reach out. There's my contact information. You may also get me on the site on the contact page. My clients, of course, have my office number. And now I'm going to cue the music and show everyone the disclosures that everyone enjoys so much. Happy holidays. See you next time.